Welcome to this Killick Explains video, and welcome to part 1 of my series on key terms for new investors. Now, these terms are relevant for experienced investors too, but I hope they know what they are. So I'm going to cover them on the basis that they're a little bit scary sounding, but they're really important, and they don't have to be too intimidating once you understand the nuts and bolts. Okay, so novices listening carefully, and those people watching with a bit more experience might want to just note that they do know what these 4 terms mean. So diversification is number 1. That's all about spreading risk. And it works on the principle that no matter what someone tells you, no matter how much you think you know about a stock, no stock is immune from trouble. And by trouble, I mean short, sharp share price drops, cuts in dividends, and so on. And if you look back through stock market history, some of the biggest companies in the market have hit trouble. BP, a few years ago now, M&S, Tesla, even Nvidia, the giant in the tech space, is not immune from volatility, from hitting problems, from changes in the backdrop. And therefore, diversification as a concept matters both for income seekers and for growth investors. Now, in practical terms, what is diversification? It's not putting your eggs in one basket. But what does that mean? Well, the capital asset pricing model suggests that as a minimum, you should hold between 20 and 30 stocks to achieve minimum single stock risk. That's the risk of any one of them, if you like, dragging everything else down with it. But do bear in mind that stock and market risk are 2 different things. So the one thing that diversification can't take away is the entire market falling. All right, your portfolio may fall more or less. That's something called beta that measures that. But the point is, market risk is not taken away by diversification, but single stock risk is, and therefore you should always aim to have a well-diversified exposure to the stock market. Number 2, volatility. Mentioned this at the start. Volatility, a scary sounding term, not something to be afraid of. It is the price for long-term returns, as Warren Buffett put it. In other words, there are no free lunches in investing. If you want the long-term returns that history suggests the stock market can deliver, you have to put up with some quite big price fluctuations over the short term. So all stocks suffer varying amounts of what's called short-term price risk, and there are ways of capturing that more scientifically. What's really important, therefore, as an investor is to get certain things right. You need to understand your own attitude to risk. You know, what would you actually do if the market dropped 20% tomorrow? Some people would say, nothing, Tim. Others might say, I would panic and bail out. And even if they're not saying that, in reality, that's what they do. So understanding what your attitude to risk is important. Tied up with that is your time horizon. You know, are you in a position to weather short-term volatility as a long-term investor? And what other resources do you have available to you? In other words, if the market were to take a hit, it usually recovers within 5 to 7 years. History suggests, were it to take a big hit, what other resources do you have available to stop you tapping in to your portfolio and potentially taking a wrecking ball to its potential of making decent long-term returns because of your wrong response to volatility? Concept 3 in this video, total returns. Now I mention this because when people say, you know, my stocks are doing well, they often mean that the capital price is going up, is rising. But actually total returns are income and capital growth together. And it's super important as a long-term investor not to forget that there are dividend paying stocks out there, and you should be looking to reinvest those dividends, not take them out and use them as kind of cash point machine, if you like. And the reason is simple. A Barclays study done a while ago showed that for the S&P 500, something like half of the post-1925 returns had come from the power of reinvested dividends over time. So the dividend might only be a proportion of a firm's profits, but the cumulative compounding effect of reinvesting it is significant. What's more, reinvesting dividends imposes a degree of discipline, I would suggest, on investors. Rather than seeing every dividend that comes through as a kind of bonus, something to spend, it actually forces you to think about long-term total returns. And fourthly, the good old king of ratios to some people, the price to earnings ratio. Now, This isn't a ratios lecture as such, but the PE ratio, you see it everywhere, it's quoted everywhere. It is a useful snapshot. And basically what it tries to tell you is a stock expensive or is it cheap in comparison to other similar stocks and the wider market. And it does it by saying essentially, if you've got a PE ratio of 10, so that is the share price, let's say of 100, earnings per share, based on the last set of accounts, let's say of 10, the PE ratio is 1 divided by the other, or 10 times. Broadly speaking, that is the number of years it will take you to break even, all other things being equal. All right, ignores things like interest rates and inflation and discount rates. And it's a really important measure because in essence, what it tells you is a high PE ratio means a stock is in demand, but also quite expensive, and a low PE ratio tells you it's either out of favor and or cheap. It's not a perfect measure by itself. You need to look at other ratios in conjunction with the PE ratio, but I would suggest the reason it appears in so many different places is that it is quite an important snapshot on whether a stock is good value or not. Now that's the first 4 terms. There are 2 more videos to follow, but for those people who want some more information right now on what I just said, killick.com/resources is a great place to go for other videos. My how-to guides, and there's one sitting next to me here called How to Invest in Equities. If you're thinking, what was that PE ratio stuff? Can I find out more? And then of course there's our quarterly magazine, which I edit, called Confidant, and that is quite a rich resource of information about companies and share picking.